July, the U.S. stock market valuations hit the steepest extreme in U.S. financial history. Some experts are comparing the market to the 1929, 2000, 2022 bubbles, but they're waiting on a blow-off top before it implodes. What's your analysis of the current markets?
So you can't compare the current market to 29 or the Y2K because we're much more extreme than they were at those times.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we have a fantastic discussion lined up, and we're fortunate to have with us David Levenson. David is a multi-decade Wall Street veteran, formerly working at Bear Stearns and Shearson Lehman, and more recently as an independent researcher in macro-micro derivatives. He's now wanting to teach people to exploit the advantage of their limit size to beat the S&P 500 every year. David, thank you so much for joining us today.
I'm excited to join you to help people really take advantage of their opportunity.
Wonderful. So it's been reported that right now, more than 60% of Americans believe that we're in recession. They're struggling with the high cost of living. They have high debt levels, low savings, and now the job market is tightening up, especially in light of the payroll revision of more than 800,000 jobs that just happened today. What's your analysis of the economy right now?
So you can look to many measurements of a deterioration of the economy, but the idea that someone's going to be very concerned whether we're in a recession or we're not in a technical recession is less important than if you look at what the nominal growth rate is, which is the measurement of real growth and then inflation. And the reason is because it's extremely difficult for anyone, particularly the Federal Reserve, to calculate inflation. And so instead of trying to gauge whether people's consumption patterns rise to the level of being positive or whether they're negative because they miscalculate inflation, I think is less important than the general trend, which is saying global demand for money is decaying. And so global growth is decaying, global revenue in the U.S. economy is decaying, and with world weakness, and we're seeing this across the emerging markets with literally record low currencies in virtually every economy all over the world. If you just take the 4th to 9th largest economies in the world, and so that's Indonesia, Pakistan, Nigeria, Brazil, and Bangladesh. That's 1 billion people, and their currencies are in free fall. What that means, as an American, their wages are going down in dollar terms, and they're going to be able to sell their goods into America at a lower price than they were just a year ago. And so the construction of the economy, GDP, is consumption plus government plus investment, and then the net imports. And our net imports are rising. It was just reported that the ports and Long Beach, they are as full as they've been with new goods, but our exports aren't exploding. And so that's going to become a drag on the economy. Whether it takes us into recession, we do have to give Obama some credit with the Affordable Care Act and with the 99 weeks of emergency unemployment insurance. So people won't be as stressed and anxious in a slowdown as in the past. So they may choose not to throttle down their consumption like they've done in the past. And so we might be able to skirt a recession for another 2 quarters. But ultimately, as we have more and more imports, we're going to have a slower and slower economy. And so the measurement issue will be get to a negative real GDP. But it could start in 2 quarters, 3 quarters, 4 quarters. But you cannot wait to adjust your portfolio for some academic 400 PhD driven data point coming out of the Federal Reserve. You must react every single week. And one thing And one of the reasons I was excited to join you today is because I want to explain to people, if you commit one day every 3 years and divide that one day into 10-minute slices once a week, and you watch where the $500 trillion and the $2 quadrillion of notional derivatives that governments have printed over the last 53 years since Nixon took us off the gold standard, then all you have to say is, where's the money going? Let me put my money where the money's going, and let me take my money away from where money is receding. And that's the primary thing. We have to get rid of friction, and we have to get rid of fiction. You just have to routinely focus your attention and your capital where capital is flowing. A lot of times people will say it's time in the market. That's very true, because every day you're in the market, you're supposedly earning 2 basis points plus inflation. So 250 trading days times 2 basis points is 5% above inflation. But that doesn't mean your feet are stuck in concrete and you're married to the same positions you have. IBM was the largest company in the world. People don't even know what it does anymore. 50 years ago, In Search of Excellence, the great book. Now, Cisco 24 years ago, they were 5.5% of GDP. They were the greatest company ever. Nobody knows what they do anymore. They're now 0.7% of GDP. 24 years later, what kind of return is that? So we have creative destruction, Darwinian investing. I just ask everyone, take the discipline, take the 10 minutes, take some of the time away. And you are a baseball fan, and you know if a slugger, and my grandfather worked for the owner of the Boston Red Sox, so I can speak to this, okay? If a player is in a cold streak, do you give him a little bench time and you pull someone else off? And if that guy who's off the bench starts doing great, they keep their minutes? Why can't people do that with their investments? Why can't you reduce gradually, slowly, a couple minutes away, a couple of at-bats away from decaying stocks? Let me give one math number. Since July 14th of this year, when Apple hit a 52-week and an all-time high, there has not been one of the malignant 7, and that's what we call these 7 large companies. They're a tumor on the nation. They're destroying industries. There are no more local newspapers with ad-supported businesses. They have power. They're absorbing the revenue, and they will be the death of American banks because of all the legacy companies that are reliant on credit from banks, and they're losing their revenue to these great companies. I mean, just today, what Snowflake, they beat on earnings, they beat on revenue, they beat on guidance, they're down 7%. Okay, it's because these behemoths, they're so talented, but at a certain point, they're not getting their capital intersector from Staples Utilities and Healthcare. They have to go intrasector, and it's pushing down Intel to new lows and doing damage all across the system. So we're now going to call it the malignant 7, okay? And this malignant 7 has not had one new high in over a month. And if you look at Staples, Healthcare Utilities, new home builders, and independent mortgage brokers, you've had well over 100 new highs. But NVIDIA, just like Groucho Marx said, NVIDIA, that encyclopedia, you've got to watch what's on the new high list. You've got to do your homework, see if it's a new high or an all-time high. Why not flow with capital? Why be a big shot and stand in the way and bail out a hedge fund or an institution with your precious capital? We're not doing that anymore.
That was a great introduction. So let's talk about the markets here for a moment. Kamala Harris recently came out and said she wants to raise the capital gains tax to 44.6% and introduce a 25% minimum tax on unrealized gains. So if an investment made a gain of 100,000 but wasn't sold, the individual then had to pay a $25,000 tax on that. Well, possibly in year two, the asset might drop below 100,000, but they're not getting any reimbursement on that tax. So what are the implications of this type of policy, especially considering that a lot of the tax base comes from investments that this policy could ultimately harm?
So if we go back into the mid 80s, a big improvement in the U.S. fiscal picture was a big rise in capital gains. And that contributed to the greatest bond rally that ever existed in America. In 23 months, we saw 30-year Treasury yields decline 6.9%. Controlling the budget is important to a certain degree. Now, just to clarify her policy position, she wasn't saying we want to harvest like during the year you're paying your income taxes, they're being withheld, but you get them back at the end of the year. The policy position is that they want you to pay a 25% tax on unrealized gains, but you would be able to collect them back, what you paid, the following year if there was a decline. That being said, it's the same thing as when Trump says he's going to do a 100% tariff on China and she says 44. It's a negotiating position. They're looking to try to get a 1 or a 2% to start. Now, I will say it's going to be somewhat toxic to some capital investment, but I have to say I'm somewhat in support of a small amount. My biggest and favorite tax, other than the estate tax, because no living person pays it. So it's beautiful because you get the use of all your money your whole life. And if you have children that are not so competent and they're not going to treat your capital well for society, they don't get so much of it. Okay. But the tax that Biden put on, the stock buyback tax, is the second greatest tax ever. And the reason why I support that and I want that to grow is we do have a tale of two cities. We have a bifurcated nation, people who are asset light and people that are asset long. And people that are asset long are getting richer and richer, and the asset light are getting more and more strained. Now, Noam Chomsky's father-in-law would stay in my family's neighborhood when he would visit Noam when he was at MIT. Noam speaks about $50 trillion shifting from the working class to the asset class over 50 years. One person working, 4 kids, a car, a vacation, beautiful life. The iPhone doesn't make up for the fact that you don't have that math anymore. We are going to have to tax capital because labor cannot make it. I was listening to an interview with Roberto Compasneto, the Brazilian central bank, Powell, Lagarde Bailey, Sarah Eisen from CNBC, probably 2 months ago overseas. And he said, Brazil has not recovered and emerging markets have not had labor recover since COVID. They just haven't improved enough. Their currencies were too strong. And so they're taxing their capital, which is inflationary. They may have to raise rates more. And what's it doing to America? It's slowing America down because their weak currencies are allowing them to export their way to us. So we do need to raise more capital. Now, it's my view, and I'm not worried about the deficit whatsoever. We have a primary deficit of 3%. Biden negotiated with Kevin McCarthy. 3% is completely sustainable. It's 2% inflation, 1% productivity. And the interest expense is really meaningless because 90 to 95% of all interest that's paid out is recycled at the auction into new purchases. Very little of it spent. No pension is spending any of that. Only a couple of people spending a little money. So the deficit beyond the primary, that's not important. We were at 5% before this deal. Now we're probably at just about 3%. That's sustainable. But if we look out over 5 years and 10 years, what's going to be the talent stack of these chips, large language models, there won't be a restaurant that has a human in the kitchen. Okay. We can only learn linearly at best. Robots are exponential. So we are not going to be able to tax people for more than another half decade or decade at the most. We're going to have to go to universal income and not basic income. We're not going to have a French Revolution. When capital, and we do expect a massive reset for 3 years, and then a repeat of 2003 with the greatest bull market in history. And in that phase, from say 2028 on, the growth of tech and the productivity and profitability and the reduction of labor costs will be so exquisite, we'll need to tax them more to cover all the taxes. It's like Star Trek.
Okay, so I do want to get into that a little bit deeper, but first I want to ask you this question. David, in mid-July, the U.S. stock market valuations hit the steepest extreme in U.S. financial history. Some experts are comparing the market to the 1929, 2000, 2022 bubbles, but they're waiting on a blow-off top before it implodes. What's your analysis of the current markets?
So you can't compare the current market to 29 or the Y2K because we're much more extreme than they were at those times. Okay. You had Cisco at 5.5% of GDP. You had General Electric and Microsoft as their cousins equaling 1/6 of the US economy. We had 3 companies, Applesoft and NVIDIA, Apple, Microsoft, and NVIDIA, equaling 33% of GDP. And the malignant 7 on July 10th, 2024, were 60% of the US economy. The greatest trade that ever wasn't shorting real estate in 2008. It was shorting the S&P 3 or the S&P 5 against the S&P 495. Amazon fell from the end of 99, 95%. Apple fell 82%. Microsoft fell 66%, but never moved higher before they went to down 75% during the GFC. So when you talk about let's call it a 30% concentration relative to GDP, and they could fall, and the math is from March 24th, 2024, when the S&P and the NASDAQ 100 peaked, you saw an 83.5% drawdown over 30.5 months going into October 8th, 2002. That included 475 basis points of easing along the way. We did not stop going down until 11 months after the final easing. So when people think that easing is good for stocks, I can give you many occasions when it was. It was good for stocks in 1994 when Mexico was blowing up and there was a problem for Citigroup, and Greenspan, who went from 3 to 6, reversed down to 5.25, and that relieved the pressure on Citigroup, and that let us take off. So there are times when you have rate cuts as being constructive for markets. That's not this time.
So so it sounds like you're expecting a widespread deleveraging event, very similar to the dot-com implosion, and you're expecting it maybe within 2 to 3 quarters. What do you see as the trigger, and how steep do you think it'll be? And am I off base by making that comparison?
So it's likely to be worse because it's going to be Y2K and GFC. It's not going to be the discrete ones. You see, back then in the interphase, and I have a personal point I need to make. The maestro, Alan Greenspan, his career started on August 11th, 1987, 50 trading days later. The Dow was down 38%. That's the bookend in the front. But at the end, he was able to drive the NASDAQ down 83.5% in 30.5 months. So the maestro is a maestro for the big banks, not for the little guy. And that's why I'm on here, and that's why you're on here. So we can help these people profit from these people that only protect banks. It is not true that the Federal Reserve has 2 mandates, which is labor and in price stability or inflation. They have one mandate with two subordinate mandates. They must protect the banks. If there's $50 billion of losses that show up on hedge funds and $100 billion of losses that show up with your listeners and retail investors, and they need to force those losses onto people to protect Citigroup, 100 out of 100 times, they're going to do that. And we just have to show people how they can see that in advance or in real time. So getting back to the question, are we going to be worse? Yes, we're going to be worse. You can see what happened going in last year, the year before, from the fourth quarter of 2022, when we tweeted out, and at the end of the space, maybe you'll put out our Twitter handle. In our pinned tweet, we show the original tweet on January 3rd of 2022, our first tweet, which says the market must go down. You need to short growth into value. You need to short crypto, Kathy Woods. You need to buy So Buy Me was the hashtag. Silver, oil, metals, energy, because it was the end of QE. So the $9 trillion that they pumped in there was going to get a sell-off in fixed income and compress the discount rate or increase the discount rate, because you'd have to compete against not a 1% bond, but a 3% bond. Okay. And then on September 21, you had to start getting long. And by October 28th, 2022, it's in our pinned tweet, we said you'll see the greatest outperformance of the NASDAQ, of the communications, discretionary, and tech as any time in 15 years, and it's going to last a couple of years. And what caused that is the government slowing the pace of removal of accommodation. They just didn't have any guts to do what they needed to do. We originally said, and all of our earlier forecasts worked except for one, we called for a bull steepener because we thought they were going to raise rates to 10%. And in doing so, they'd cause the long end to just sell off from deleveraging, really pancake stocks, pancake housing, and really get a lot of this leverage off. They didn't have the guts to do it. They started signaling, well, we don't want to go 100. We're looking to go 50. And that came out in the September 21 minutes. So the question is, why do we draw down so hard? You can look last year. What was going up? What was going down? You just had a melt up in the malignant 7. And they were getting their vitality, their energy, their tumor. They were getting this energy from shorting XLU, XLP, XLV, Staples Healthcare Utilities, because they weren't going to grow very much. And so while the fast growers were doing great, they were going to have plenty of time to exit their short positions in the XLU, XLP, XLV. And on the retail level, people said, my S&P isn't going up very much. The malignant 7, it's going up twice as fast. Let me divert some of my S&P 500, where I'm sending money into all 11 sectors. Let me just send it to growth. Let me underposition value. So you had the non-leveraged people diverting their investment automatic flow into these companies, and then undervaluing the other. And then that stopped accelerating. And then you can see starting this year, and our forecast for this year was a shift from last year. Last year was the hashtag T7Q3, the top 7 names in the QQQ. That's the malignant 7. This year we switched to G7D3, and that is the G7 countries of the world are going to experiencing a decline in duration demand. People aren't going to have the confidence to borrow as much, whether it's to buy inflationary investments or just neutral investments. People are going to want to stop borrowing, and you're going to see rates come down. And that is the death of banks.
Perfect segue into this question. So Warren Buffett just sold another 14 million shares of Bank of America stock. Since the end of the second quarter, less than 2 months ago, he sold more than $4 billion worth of Bank of America shares. What is his stock selling of Bank of America say about them and the state of the banking industry as a whole?
So if I can amplify what you said, it's not just that he did what you said, but he's been selling every day.
Yeah.
Because he wants to get out without moving the market. So my partner was at Goldman Sachs for 22 years before bonds even had options. Okay. And he ended up running the volatility book to manage the price risk of their fixed income portfolio and their mortgage-backed security portfolio for the salespeople that were going to sell it. And he was doing that for 22 years before he went over to Deutsche Bank. And he and I were neighbors. We met just around LTCM. He knew my sister from Goldman Sachs. She was a real superstar. And we would talk in the elevator. We'd meet. And at some point we said, we have a great model. I had one and he had one, but we had tracking error. There's something we were missing. And it turns out why. So he's on the fixed income side, fixed income and mortgages. And at Goldman, every time markets got sloppy, everyone say, call Don, find out what's going on. Because they say the bond guys, they don't get paid the most, but they know the most. And I came more from fixed income and equity. Okay. So when we fused our models, I mean, think about this. Before the most recent run up in stocks, say 3, 4, 5 years ago, the stock market was like $20-25 billion of equity, which means it's a short volatility product. It's Goldilocks. You need a stable. You can't have too hot of inflation. You can't have too cold deflation, or stocks don't work. Same thing with mortgages. It's a short volatility product. It's really functionally the same thing. So when you merge the two, you get a model that doesn't have tracking error. It's like flying a plane and someone's controlling the other engine, and you don't even know what they're doing. So once we got to that, I learned more about banks and mortgages. He learned more about stocks. So let's talk about banks. I would say if you look at banks today, they seem fairly okay. Their net interest margin was weaker than people expected. But if you do any first order analysis, the banks in America are insolvent. Citibank is insolvent. Bank of America is insolvent. Wells Fargo is insolvent. We can look back to the savings and loan crisis for a reference point. And if you have a Twitter account, I will post the charts on there. There's an excellent chart from 1983 when Volcker was jacking rates up to 20%. The unrealized losses on the portfolios of the savings and loans did cause a few Silicon Valley, First Republic situations. But for the most part, if you've got a sovereign and it gets impaired, it goes down in price a little, and it's in your held to maturity portfolio, not your available for sale, and you're not required to hit your net income statement, and you can still make your regulatory loans. There's plenty of liquidity. It's going to go down in price. It's going to come back. It's a sovereign. There are facilities, discount window, whatever. The problem wasn't in 1983 for the savings and loans, and it wasn't last year in February. It's so funny. Powell is talking about all these hot jobs. He may have needed to raise rates by 50 basis points, and he caused the 2-year yield to go down 130 basis points. They call it a 12 standard deviation event, and they blew up, Silicon Valley and First Republic. And we all know now that, those data points weren't really accurate. Okay, so what happened in the savings loan? So once you got a rollover in commodities, and we're on board with a lot of people, gold, silver, uranium, copper, aluminum, iron ore. We're going to have the greatest super cycle ever. It's just not going to start for 1,000 days. We have to do the deleveraging first. You can see, China's real estate bubble decelerating at the new record speed of 8.2%. They don't need any copper. Their iron ore, it's down 30%. They just warned it's going to be a winter. But the banks started to have problems in the early 80s. You had a lot of smaller banks go bankrupt. The largest bankruptcy ever to date was Continental Illinois. The Jeffries building, I believe, is in their old headquarters, that beautiful marble on Madison and 53rd. And what happened is they accumulated some futures brokers, some oil banks, and they just, a sick person buying other sick people. When you have a commodity deflation, it's toxic and it rolls people. That led to the biggest bond rally ever. So what happens? Rates come down. Everyone's goo-goo gaga. Okay. They're saying, oh, Bank America with their big impairment, the impairment's going away. Buffett's selling on the impairment going away. Because when the impairment goes away, that's the last stage before the equity goes away. Because what happens is when the impairment is there and rates are high, banks are lending money like crazy. They're lending money to people that could never get money in another time frame. They're lending to people that can fund their inventory because they're making so much money on the new mortgages. Okay. What happens when rates come down? The net interest margin comes down. Remember, a bank has rigid fixed liabilities like Fannie Mae and Freddie Mac. Okay. The inverted yield curve always works and it's always right. It's just not always right on day one. If you're going to neutralize that by a lot of fiscal excess spending, and then Europe is going to intentionally hold their currencies up to allow the American dollar to temporarily stay down, maybe because they have a calendar date in mind like Y2K, maybe Europe wants November 5th to pass without a big problem in the US because they don't want their NATO bill to go up by 50% and because they don't want to have a tariff across all their paper. I don't want to mind read. What I do know is Europe is doing much more QT than the United States, and their economy is much worse, and it's not explainable. Bailey at the Bank of England was originally saying, we're going to start easing as we get our inflation towards target. He changed his mind. In England, in England, their inflation rate fell to 2%. Did they cut? No, they didn't. Their forecast for the next month was 1.9. It ended up coming in at 2, but their forecast was 1.9. Did they cut? No, they didn't. Why would they want a real rate of 3.25 when their economy is a disaster? You can explain it as trying to keep the dollar down, the U.S. stock market up, U.S. commodities a little higher, U.S. GDP a little higher, U.S. net imports a little lower to try to get past November 5. But any other explanation we have been searching for and we haven't been able to find it. And so the U.S. banking system, when you have a 5% 10-year rate and you've got an 8% mortgage, I mean, this is nirvana for the banks. They're lending to their worst customers so they don't become a credit liability when they go bankrupt. And this is what happened during the savings and loan. And I'm going to send over the chart, which shows first you had the jump in the unrealized losses as they came back down, which is, dovetailing with Buffett selling his Bank of America. Then you got the credit. When credit losses pick up, you're not getting a penny for your loans. When a sovereign, when a mortgage, when a treasury gets impaired, you're going to get 100 cents on the dollar eventually. But when the economy slows, you start getting more and more credit losses, and then you're not allowed to make loans. It's a regulatory thing. It's not a decision. It's a regulatory thing.
So what happens when? So you're expecting a savings and loan part 2?
Worse. No. See, one of the things that happened in the savings and loan, the trigger, the catalyst, was Europe was pressuring America terribly because of our deficits. And Graham Rudman, they raised taxes in the Tax Reform Act of 1986. And you're too young to remember this, but some of your listeners might not. Might know this, but you used to be able to write off passive losses on real estate. So you could buy a property with an interest expense with so much leverage that you lose $100,000 a year on $1 million property. You could write that $100,000 off. You were buying things because of the tax credit. This wiped it away except for incomes under like $100,000. And so that wiped away a lot of the equity in a lot of real estate, which helped the credit issues. But for now, it's much worse than that. It's not just the real estate problem. We have the commercial real estate, which is going to go two full waves of bankruptcy. First, they're going to get rid of all the equity. Then they're going to have to write down the debt. And then we just have a lot of credit card debt. That's going to go bad. We got a lot of debt. We've got record debt. It was reported to say
Yeah, so in 2008, we had the bailout, and they passed some new banking laws, and in there was some bail-in language. Are you expecting a bail-in where they can, I guess, quote-unquote, confiscate, folks' bank accounts in order to help stabilize the banking system?
Well, we did start this podcast talking about 100 out of 100 times they'll do whatever they need to do to bail out the banks. There's no question they have to do it. Remember, during COVID, they paid the pilots their salaries. Many people don't realize this. If a pilot resigns or a pilot is furloughed, they basically got to train a ton to get back in the plane. If we weren't paying them their salaries, we never would have stood up the airline industry. What are you going to do with the banking industry? Are we going to become Sweden, where the government basically owns them? So the problem is that, and this is another thing I'll send out. We watch all the banks in the world, okay? But the three big banks that you've got to watch is BNP Paribas, which is now smaller than Rocket Mortgage. So the premier French counterparty bank, which used to have a AAA rating, is smaller than Rocket Mortgage. Is that registering with people? An online mortgage broker in America is worth more than BNP Paribas. Excuse me, it's worth more than Deutsche Bank. Excuse me, BNP Paribas is worth almost twice as much as that, and then Citigroup. You've got to watch these three banks. The counterparty exposure, the off-balance sheet risk that these people have. I mean, some people say Citigroup was 80 times leverage when you factor in off-balance sheet in 2008. One of our tweets lists the 20 times where the Fed accommodated Citibank's mistakes. And Jane Fraser, who runs it, she's a terrific person. But when she tried to sell her mortgage business, she didn't get a bid of $1 and they closed it. And when they tried to sell their credit division, they couldn't get a bid of $1 and they closed it. Wells Fargo just sold the rest of their mortgage servicing rights to an Atlanta non-public firm. The banking system has more leverage than at any time before, on balance sheet, off balance sheet. But if anyone's heard of the term Basel III, it's Basel fake, okay? They pushed it off until after November 5. They were supposed to raise more capital, but they didn't. There's this incredible person. She wrote a great book on banking. She's a professor at Stanford Business School, Professor Anat Admati. She's really the greatest person in banking as a professor. She has a famous line. It was on Joe Weisenthal's podcast with Tracy Alloway, the Odd Lots podcast. And what she said is, when a bank has the ability to raise capital, it doesn't matter what the price is, raise the capital. These banks are talking about, we passed a stress test, so we want to pay dividends and buy in stock, as opposed to pay off our debt. Does anyone remember Credit Suisse? It's Citibank with an S on the end, okay? They evaporated over the weekend when their contingent capital bonds, their COCO, as they call them, they just evaporated. They disappeared. So one of the things you can do, because a lot of people don't have access to the pricing of the credit default swaps of these banks, you can just put on your ticker CDB and BNP, and you'll be able to get it on Gary's Twitter account. You've got to be watching these things. A lot of people will talk about the money center banks, the big four, JP, Bank, Citi, Wells Fargo, and they'll talk about, oh, they're only 1.5 trillion or 1.25 trillion versus, let's say, 50 trillion for the S&P, for the US markets. So it looks like it's only 2.5. That's their equity. How about the enterprise value? They have 9 trillion of debt. Okay. They have 9 trillion of debt. So they're really 10 trillion of a 60 trillion S&P. So it's a much bigger share.
So
and we know,
I was going to say, you're really painting a picture here between the banks having a bigger problem than the savings and loan of the 80s. The current market bubble is bigger than the combined problem that we saw between Y2K and the GFC. The real estate issues, the balance sheet issues of the Fed, you're really painting
it's very simple. It's everything everywhere all at once.
Yeah. So all of that, all of that has to wash out in order for us to get back to a clean place. What is that wash?
It's called gravity. It's called gravity.
Yeah. So what is that?
It's called deflation.
What is that deflation, that gravity? What does that look like? What are we going to see here in terms for the everyday man and woman? What's going to happen?
So from an equity investment standpoint, it's really beautiful. Okay. Listener exercise. Okay. If you never took a physics class, you've never heard that phrase. You got to do the work at home. Very easy. I need everyone to chart from March 24, 2000 to December 31, 2003. The QQQ, which peaked at 120 and change and troughed at $20, below 20. The SPY, okay, and then each of the 11 sectors in the iShares Barclays sector spiders. So CKY is XLC, XLK, XLY, comm, discretionary, and tech. VUP, XLV, XLU, XLP, that's healthcare, staples, and utilities. And then the 5 nonsense sectors, which are basic materials, energies, financials, industrials, and commercial real estate. They're the ones with so much leverage. There's no time to get out of that. You'll never be able to get out of those in time. Okay. So, we kind of focus on the one end, CKY, and the other one, VUP. So when you do this charting exercise, what you will find is in the first year after the peak on March 24th, 2000, which parenthetically, Greenspan hiked rates on February 2nd, 25. He hiked rates on March 21, 3 days before the peak, plus 25. And then 7 weeks after, on March 16th, he accelerated and hiked 50 basis points. Now, some people, and it's my opinion, that he was very interested in trying to get Al Gore elected, even though he said he was a Republican. And by raising rates that 50 basis points, he was able to get the S&P, which peaked on March 24th of 2000, back to its old high on August 30, 2024, 5 months later. It destroyed the economy by bringing forward all that inflation to help get the S&P up. But it caused a lot of damage. But when you do this exercise, what you'll find is there was a 60% draw in the QQQ, the NASDAQ 100. At the same time, a 28% rise in utilities and staples. What was that? That was money going into the growth funds and, ignoring or diverting away from the value funds. And for good measure, some money that was going into both in the S&P 500, the SPY, it started going to growth. And so the unwinding of that leverage, the leveraged players or the underweighters produced the deleveraging, which was manifest in the rise that you can see in the yen, you can see in XLU, XLP, XLV. Again, we had 19 new highs in utility staples, healthcare, new home builders. Today, over 150 since July 15th. We haven't had any new highs in the Malignant 7 and NVIDIA. So where is the money going? It's the unwinding of the leverage. Where's the yen right now? We're literally back at the low. Okay. And if you want to know why the yen is moving, it's something I'll post on your site also. There's something called the red pack. The red pack, there's the white pack, the red pack, the green pack. That's the Federal Reserve quarters. It's the 2 meetings you have per quarter. 1 quarter, 2 quarter, 3 quarter. So you have a whole year, 4 quarters, the Fed funds contract or SOFR for 1 year. That's the white. And then the second year is the red. So 5 quarter, 6 quarter, 7 quarter, and 8 quarter. And that shows where the market thinks interest rates are going to be. So Japan, their red pack started to go down in price, which meant a higher implied yield. They were actually going to go to positive rates. Us, we were going to cut. Okay. We were going to cut on November 2nd. Greenspan gave the all clear at the press conference on November 2nd. And we went from an SEP, which is a summary of economic projections, of 75 basis points over the next 7.5 weeks until the trough in yields at 394.2 for the 30-year, and the 10-year was around 380 or so. They saw those rates go down. They saw the yen go up. The yen was 151.93 or so on July 12th, 6 trading days after the Fed unleashed traders to buy our red pack to cover their shorts because they were going to be cutting. It was priced in 175. And they used the fake story of bad inflation, which they know has been seasonally distorted for years. They knew they could have overlooked it, but they didn't. And they removed all of that accommodation, 175 basis points. And that's when we saw the opportunity. Because on February 13th, the British 2-year yield, the 2-year gilt, their yield peaked. Okay. Our 5-year yield peaked on April 30. Why would they peak while the Fed is still removing accommodation? And K2, Kashkari, he's got 2 Ks, and Michelle Bowman are calling for rate hikes. But the 5-year is ignoring them, giving them the Heisman. Okay. Then what happens? That's April 30. May 20th, copper peaks, May 29th, aluminum peaks, June 18th, NVIDIA peaks. I neglected to mention SMCI, which is very important to watch. It peaked, I think, March 8th. See, SMCI isn't like a regular stock that you can look to the options market to see what the open interest is on the different concentrations where the dealers are mispositioned. There's a giant block of a convertible note, which has an embedded option, which is essentially an off-balance sheet thing. So it's actually much more volatile than you could ever get just looking at the options open interest on their different racks that are exchange traded. But then you go to the June 18th, and then what do we get? We get PCE at the end of June. That was the evidence that it was ridiculous for the Fed to have countenanced the value of seasonality distorted inflation for the first 2 or 3 months. It's been a problem for years, exacerbated by COVID. But once you got to the June PCE, that was it. That's when people started buying not just the 2-year gilt, the 5-year Treasury note. They started buying our red pack. We started converging again. Remember, we went from almost 152 the yen to 142. That's when the Fed started screaming higher for longer. It was because the yen was about to explode after a 12-year drawdown. Okay, so what happens next? They do higher for longer. They blow through the 152 low from last year. They take us to 162. Doesn't matter. That was it. So we went right back to 141, and that's part of the deleveraging that showed up on August 5th, which the Fed was very careful to block because we think they have a calendar issue of November 5th. So what they did is they had an emergency meeting not to ease rates and take the September 18th Fed funds rate from 5 3/8 to 4 3/8 with an unscheduled 50 and a scheduled 50. No. They immediately went into the system and said, don't you dare buy a red pack. Short that. Sell that red pack, push it down, stop that yen rally. So we started to reconverge, or rather widen. We were converging with the yen's red pack. So our expected rate cuts in America, married to their expected rate hikes, was converging the interest rate differential, bidding up a 12-year low. They said, stop that. And they pushed our red pack right back down. Remember, they pushed our 10-year all the way back up. They pushed our 2-year up 40 basis points. Where are we now? We're giving the Fed the Heisman. We don't care about the data, these 818,000. Nobody didn't know that data wasn't real. We know that they had 11 out of 13 downgrades. We know it's all part-time jobs. We know as of late, there were no private sector jobs other than healthcare. In April, we had 9,000 non-healthcare private sector jobs. And now it's less than that. We had 1 month, the birth-death model was 300,000. We would have had negative jobs.
So David, let's try to land the plane here.
Okay.
Yeah. So I you're painting a picture for us, to me, that we're going to be going through a period of time of significant downgrade. The deleveraging is going to hit the regular economy pretty hard. The everyday man and woman, we're going to feel it. It's going to be an impact on all prices, real estate, everything that we deal with is going to
deflation.
Yeah, deflation, which is going to lead to job loss. Massive job loss. So
part of the job loss is going to be that we have such favorable, and I'm completely in support of, healthcare is much more attractive now with Medicare. And then the unemployment benefits are going to be there. And also, it's very likely that they're going to dust off, at least in the blue states, the rent moratorium when you get a trigger of a high unemployment rate. So people won't have the same anxiety and stress as the past. So that I'm grateful. And the deficit's going to come crashing down. A lot of people say, well, we're not going to have as much income. We're going to lose $500 billion of interest expense when the Fed goes from 5 3/8 back down to zero. Okay, where's your deficit now? Okay,
right, so you're saying that the Fed is going to take it all the way back to zero.
Well, Citibank is going to make the call.
Are they going to?
They're going to say either you take it to zero, or we have going concern issues.
Are they going to bring in the helicopters and print money again and dump
but that's what it is. But that cutting the rates is the same thing.
Yeah.
So, but the two things I want to highlight, it's the greatest opportunity for your listeners in history, because forget private equity nonsense. These people mark these things at such crazy prices. You can't get your money out. Go try to get a redemption on a PE fund. No one's giving you any money. Okay. But the private sector. So when you do that exercise we talked about, charting the subsectors, particularly XLU, XLP, XLV, you had 1 year where these things went up beautifully. And then the equity and the economy started to deteriorate to the degree that we had a rise of ERP, equity risk premium. And then at that point, the only thing that went up were treasury prices. And so you have the ability to every week be an accelerator. You start small, you move 2% of what's not working to what's working. And you can accelerate. And if and what you buy doesn't go up more than what you sold, pause. But if you're buying things that are going up faster than the things you're selling, keep on doing it. Do what works. And then you have an opportunity to grow your capital. Instead of watching your Amazon shares fall 95% and waiting for them to come back. Instead of having one share, why don't you sell it and buy 20 shares later on? Okay. So yes, it's going to be a problem, but people that are willing to watch, get rid of the friction, get rid of the fiction, invest based on observation, not narration. They'll be in such a strong position when the super cycle happens. It'll be the greatest time ever.
So I have a final question for you, David. Gold recently hit its all-time high as it cruised through the $2,500 threshold. This is done on light volume with little Western investor help, and at a time when China has stated for the last 3 months that it isn't even buying any gold. So gold has many tailwinds, not those three withstanding. What is gold hitting 2,500 saying to you, and what stops gold from continuing to rise moving forward?
So we like to always frame things in intuitive ways so people can kind of see things, whether it's time dilation from the special theory of relativity. It's from your perspective. Light will move faster or slower. So let's not only look at gold. Let's look at its pair, okay? Gold's pair is silver, okay? We know that after Nixon depegged, gold was 35, silver was $1. That's 35 to 1. At one point, with the help of the corrupt Hunt brothers and with the assistance of Saudi Arabia in 1979, they got silver to go to $50. And then it was only 50 versus 815. I mean, 850, silver 50, gold 850, 1/17. Okay. But they have a historic relationship just based on how gold and silver are formed in outer space, in the space between two supernovas exploding in tandem, stripping off electrons from lead and producing all the precious and basic materials. And 4.5 billion years ago, when the Earth was formed, it was layered like a chocolate ripple in the planet Earth. So you'll find silver in gold mines, you'll find silver in copper mines, you'll find some gold and silver mines and gold and copper mines. They're all kind of related, but it's about concentration. Would anyone feel comfortable running up a down escalator if they just knew there was one escalator after another and they're all running down? The answer is no. You rather run up or walk up or sit on a rising escalator. You have to look at gold in the context of silver prices. Historically, the gold-silver ratio is very determinative. Gunlack likes to use copper gold for economic activity for his 10-year, but just for precious metals trader, it's very constructive to look at that, chart that ratio, and you're seeing a decay. You're seeing a decay in silver relative to gold. That's concentration of capital. That's the malignant 7. They're getting all the but eventually the down escalator picks up a gear, and it's a problem. So before you get nervous of gold, you'll need to make sure that silver's getting weaker. But if you see silver getting weaker and breaking down, can you feel comfortable being long gold? Does that mean you blow it out day one? Of course you don't. We're not going back to $35 gold. That's not happening. But what it could mean is you can write some volatility against it. You could do some shaving and try to find something that's going up reliably faster. Maybe look at a 30-year treasury, which had been underperforming gold, but gold versus TLT, that's changing. Gold versus ZROZ, that's compressing. So if you could just look at these things like a video gamer, as an avatar, as a QSIP, and not have the emotion of gold's going up, look at that price with respect to other prices. Look at it with respect to silver. Look at it with respect to TLT. Look at it with respect to ZROZ. And if some of them are moving up, doesn't it militate to give a little love to what's working? Just a little, just a taste.
Yeah. So this has been a wonderful conversation. Before we wrap up here, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. Just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with David as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. David, I want to thank you for coming on to the Metals and Miners podcast and for being so generous with your time and your analysis and your ideas. It's been incredible to spend the time with you. Would you please share with the viewers any key message that you want to leave with those tuning in, where they can learn more about your work and how they can connect with you?
So we do an X or a Twitter account. It's ampersand, Levenson _David. And you'll see this gorgeous dog right over here in my arms. I am in front of the house that Joe Kennedy Jr. was born in as my Twitter picture, with my little dog in front of the sign, the 100th anniversary of the death of Joe Kennedy Jr. And so at Levenson _David, and I think it might be linked to Gary's site. And I just would beseech people, you have a lot going on in your life. Children, medical issues, work. If you donate 10 minutes per week, you'll get used to the idea. It doesn't exactly have to be the same day, but you must remove the fiction. You must remove the friction. And then you always have to look at one asset with respect to another, like you're on an up or a down escalator, and always A/B test and be less dogmatic. Trust your instincts, but confirm with price. And so just as one example, because gold is very important and there's going to be a great super cycle, we feel there'll be a big deleveraging episode beforehand. But if you can have your capital hosted in a stronger asset while you're getting ready for the greatest trading opportunity ever, it really is something to consider, doing a gradual 1 or 2% shift, revisiting it a week later, see if it worked. You're allowed to turn back time and reverse that money. I understand there's tax issues. That's why it's great if you start doing it in an IRA or a Roth account, so there isn't a tax issue to discourage you. And then you could flow it back and forth. But when it accelerates, which is called momentum plus acceleration, nonlinearity, then you have the opportunity to be at maximum strength for the thing you're hoping for, expecting, and certain is going to happen. You'll be there to take advantage, and you'll beat the market every year for the rest of your life. And you won't be trapped in some of these old canards about institutions have the advantage over you. Hedge funds are doing better than you. They're not. That's all I have to say.
Well, I appreciate your time, David. I look forward to having you back on. Thank you for being here with us, and everybody else, thank you for watching. Been a wonderful conversation. Before we wrap up here, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. Just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.